Lenovo just reported a $609 million quarterly loss. Then its shares surged to a record high. That sounds impossible until you look at what was happening underneath the headline. Revenue jumped 43% to $26.9 billion, the fastest quarterly growth Lenovo has reported in 5 years. AI-related revenue climbed 60% to $9.3 billion, meaning roughly 1 out of every $3 Lenovo generated was already connected to artificial intelligence, and its pipeline of potential AI server business reached $54 billion. The loss was largely an accounting effect. Lenovo recorded a $1.7 billion non-cash charge after the value of warrants issued in 2025 changed as its own share price surged. Excluding unusual items, adjusted net income actually jumped 176% to more than $1 billion. So the real question is not why Lenovo lost money. It is how the world's largest PC company suddenly became one of the fastest growing AI infrastructure businesses. And the answer reveals something important about the next phase of the AI boom. Lenovo does not need to invent the smartest AI model. It needs to sell the machines that run them. For decades, Lenovo was associated mainly with laptops and desktop computers. Its acquisition of IBM's PC business helped turn it into the world's largest PC manufacturer, and that scale created a global network of suppliers, factories, distributors, and enterprise customers. But PCs are traditionally a difficult business. Margins are relatively thin. Customers can delay upgrades, competitors offer similar hardware, and when component costs rise, manufacturers have to choose between accepting lower profit or raising prices and risking weaker demand. That problem is happening right now. Global PC shipments declined in the latest quarter as memory prices rose sharply. DRAM and NAND chips, which store and process data inside computers, have become more expensive, partly because memory manufacturers are directing more capacity toward high-value AI data center products. Normally, that would be bad news for a PC manufacturer. Lenovo turned it into an advantage. The company anticipated the shortage, diversified memory purchases across suppliers in China, South Korea, and the United States, and raised PC prices twice this year. At the same time, it shifted more customers toward premium devices where higher component costs are easier to absorb. Imagine two laptop companies, both normally sell a computer for $1,000. Memory costs suddenly rise by $100. The first company keeps its price unchanged and loses $100 of profit. The second company upgrades the processor, adds AI features, positions the computer as a premium model, and sells it for $1,200. The shortage affected both companies. Only one turned the problem into higher revenue per customer. Lenovo is trying to do exactly that. Its PC, tablet, and smartphone division generated $17.1 billion in quarterly revenue, up 27% year over year, even though the wider PC market was under pressure. Lenovo also strengthened its global PC leadership, with its own investor materials reporting a 25.1% market share during the quarter. But PCs are no longer the most interesting part of Lenovo. The real acceleration is happening inside data centers. Lenovo's Infrastructure Solutions Group generated a record $8.5 billion in quarterly revenue, up 98% from a year earlier. Operating profit reached an all-time high of $777 million, with a record operating margin of 9.1%. Both its cloud service provider business and enterprise business nearly doubled. This is where Lenovo's AI strategy becomes much larger than selling AI laptops. A modern AI server can contain GPUs worth hundreds of thousands of dollars. But the GPU is only one part of the system. The customer also needs CPUs, high-speed memory, storage, networking, cooling, power systems, motherboards, racks, software, and services to make thousands of processors operate together. This is similar to what is happening at Foxconn, Dell, Supermicro, and other infrastructure companies. NVIDIA designs the most valuable component. Other companies turn that component into a complete machine customers can actually deploy. Lenovo already knows how to do this at global scale, and its $54 billion AI server pipeline shows how large the opportunity may become. That pipeline increased 157% in only one quarter, according to Lenovo, driven by hyperscalers, AI cloud companies, and enterprise customers. Not every dollar in a pipeline becomes revenue, but the direction matters. Lenovo is increasingly selling expensive computing systems to the same customers, building the global AI infrastructure boom. This creates a different economic profile from consumer PCs. A company might buy 10,000 laptops. A hyperscaler might place one AI infrastructure order worth hundreds of millions or even billions of dollars. One customer can dramatically change Lenovo's results, but large orders also introduce risk. AI servers contain expensive components, particularly GPUs and high-bandwidth memory. Revenue can grow rapidly because each system is worth so much, while profit margins remain relatively modest because Lenovo must pay suppliers for those costly components. This is why hardware companies can report spectacular revenue growth without producing NVIDIA-like profitability. The most valuable component may still belong to someone else. Lenovo's strategy is therefore to capture more of the system around the chip. It sells infrastructure. It sells devices. And increasingly, it sells services. Its Solutions and Services Group reached another record quarterly revenue level and a record operating margin of 24.2%. That margin is critical. Selling a server may create revenue once. Managing the server, maintaining software, integrating AI systems, providing cybersecurity, and helping customers operate infrastructure can create recurring revenue for years. This is the same business transformation many hardware companies are pursuing. Use hardware to enter the customer relationship, then make more money from software and services around that hardware. Lenovo calls its broader strategy hybrid AI. The idea is that AI will not run only in giant data centers. Some intelligence will run in the cloud. Some will run inside corporate servers. Some will run locally on PCs and smartphones. That matters because not every company wants sensitive information sent to a public AI service. A bank may want some models inside its own data center. A factory may need AI close to its machinery. A consumer may want certain AI features operating directly on a laptop without uploading personal information. Lenovo sells products at all of those levels. An AI PC can handle local tasks. Lenovo servers can run private enterprise models. Its infrastructure can connect to larger cloud systems. Its services business can help customers combine them. This gives Lenovo a different position from companies focused on only one layer. OpenAI sells intelligence. NVIDIA sells computing. Cloud providers sell centralized infrastructure. Lenovo wants to sell the physical system connecting personal devices, enterprise infrastructure, and cloud AI. That is why CEO Yang Yuanqing believes Lenovo can become not just the world's largest PC company, but a global AI infrastructure leader. There is still a major risk hidden inside the latest numbers. Lenovo's shares had already gained more than 200% this year before the results. Expectations are becoming extremely high. We have already seen what that can do to AMD, Cisco, and other AI-linked companies. When investors price in enormous future growth, even strong results can disappoint. Lenovo also depends on a semiconductor supply chain it does not control. Memory prices are helping Lenovo raise selling prices today, but persistent shortages could eventually damage demand. GPU availability can limit AI server shipments. Trade restrictions could affect which processors Lenovo can sell in certain countries. And because Lenovo operates globally, geopolitical tensions between China and Western markets create an additional layer of uncertainty. Yet its supply chain may also be one of its strongest defenses. Lenovo sources components globally and manufactures across multiple regions. That scale gives it more negotiating power than smaller hardware companies and more options when one supplier runs into trouble. The memory shortage provides a good example. Rising costs hurt the entire PC industry. Lenovo did not eliminate the problem. It managed the problem better than many competitors. And that is often enough in a low-margin industry. The company now expects to reach $100 billion in annual revenue this fiscal year. If that happens, the transformation will be difficult to ignore. Lenovo will still sell hundreds of millions of familiar devices, but behind that consumer business, another Lenovo is emerging. One that sells AI servers to hyperscalers, one that sells high-margin services to enterprises, one that uses AI to push customers toward more expensive PCs and smartphones, and one that can potentially make money whether AI runs in a data center, inside a company, or directly on a person's laptop. The most interesting part is that Lenovo did not abandon its old business to enter AI. It used the old business to get there. Its global factories created scale. Its supply chain created resilience. Its PC relationships created distribution. Its enterprise customers created a market for servers and services. AI is now making all of those assets more valuable at the same time. That may explain why investors looked past a $609 million headline loss and sent the shares higher. The accounting said Lenovo lost money. The underlying business said something very different. The company that became famous for selling PCs may be turning itself into one of the largest hardware platforms underneath the AI economy.